Assalamualaikum and a very good day I bid to our lecturer, Professor Madya Dr. Nur Afza binti Amran. My name is Huda binti Ahmad Zuhairi with metric number 261041 will be presenting on the third case, the smell, taste and touch of money and accounting policy decision. Before we going through the case analysis, I would like to point out and summarize few important points throughout the case. The key protagonist for the case would be MIM Holdings. The case started when the investment decision made by MIM back in the late 2017. Since UPC contributed to the initial funding for the investment amounted to 18 million ringgit Malaysia, fully utilized for the investment, Aina thought that it was a warm gesture from UPC Berhad as a parent for their company as subsidiary. Even their external auditor, which is MJ and Associates, advised her that the fund should be recognized as equity, since they thought that the cash pumped by the parent was supposed to act as a support to the performance of their company as subsidiary. However, in February 2018, the initial recognition resurfaced, as they started to convene with accountants for UPC for its consolidated financial statements. Aina was stressed out as their company was way behind the deadline to produce a consolidated financial statement of 2018 for their parents, since they faced the dilemma on the recognition of fund for the year 2017. UPC, who used different external auditor to audit their financial statements, who is GA and Associates, they called an attention on the recognition of the funds transacted. In due course, the fund was recognized as a debt and MIM needs to pay to UPC. The main issue for this case would be whether the amount of fund contributed by UPC should be recognized as equity or debt, as being assertive in two different opinions from each of the external auditor. Unfortunately, during 2017, on the preparation for the accounts, the parent vehemently rebuffed the injection of fund to be recognized as an additional capital contribution, since they wanted to reduce the financial dependency of MIM on the parent. What would be the causes of problem for this case? According to MFRS 10, UPC have a direct power on MIM as a parent, where they have fully right to use power on MIM for their own great returns. Despite the power they have on MIM, as stated in MFRS 132 para 17A, a preference share that provides for mandatory redemption by the issuer for a fixed or determinable future date, or give the holders the right to require the issuer to redeem the instruments at or after a particular date for a fixed or determinable amount, is a financial liability. The injection of fund was termed as Redeemable Convertible Cumulative Preference Shares, RCCP, eventually in 2017. This indicates that the fund acted as a liability or debt and MIM was obligated to pay for it. Adding up to that, the fundamental principle of IAS 32 is that a financial instrument should be classified as either a financial liability or equity instrument, according to the substance of the contract, not its legal form and the definitions of financial liability and equity instrument. The entity must make the decision at the time the instrument is initially recognized. However, when the transaction happened, both entities, UPC and MIM, did not give much emphasis on the nature of the financial instruments. The primary concern for MIM was only to have sufficient cash to secure the purchase agreement for the investment, and UPC was only offering to fill up the balance to acquire the investment, since MIM is a special vehicle for the UPC to generate income for the parent, and the expected MIM is able to pay back the injection of fund from the return of the investment. MIM was not able to recognize the fund first initially when they were injected, and UPC have the fully right to instruct MIM to pay back the fund as debt, since the initial intention was to lend money for MIM to acquire the investment, not as the capital contribution. Why they recognize the fund as RCCP? R in RCCP stands for redeemable because it provides the company with an option to choose between whether to repurchase shares or redeem shares depending on the market condition. RCCP provides the holders or UPC the priority over the ordinary shares in two ways. RCCP has a fixed rate dividend where shareholders receive before any dividend were to be paid to ordinary shareholders. RCCP also will rank ahead of common shareholders in the return of capital from the assets sold on the event when a company suffers bankruptcy. The words convertible indicates the holders can convert the class of shares to the ordinary shares if they ever see rises in the company's stock. They have the opportunity to earn profit more. Even so, RCCP holders have no voting right and it must appear legibly on the share certificate, prospectus or directors' report issued by the company according to Companies Act 2016. However, the original article of Constitution of MIM did not state equity other than ordinary shares. The company secretary of MIM had to redraw the article of Constitution under special resolution. According to Companies Act 2016, Section 36, the company may alter or amend its constitution by special resolution. After the alteration, the company or the secretary should notify the registrar and launch a copy of the altered constitution within 30 days from the date the special resolution was passed. What would be the next steps or solutions that the company need to implement based on the criteria that should be considered, which is going concern for the company? The company should conduct a solvency test by calculating their ratio analysis. Solvency ratios is calculated usually to observe the company has manageable debt load and positive net worth. Since injection of the funds was recognized as debt, they need to reflect on their company performance and decide on the appropriate step. Debt to equity was calculated to indicate the degree of financial leverage, which includes both long and short-term debt. The higher the ratio implies that the company have problems in their credit rating. It will be more harmful for the company to add more debt since they are not capable more to pay for the debt. While for debt to asset was calculated to measure the company's total debt to its total assets. A higher ratio above 1.0 indicates that a company may have difficulty meeting its obligations even with their available assets. A few solutions were to suggest to the case, which are whether the company should continue its operations and continue in paying their debt with another way of finding more profits, or to close their company by selling off their assets to pay for the debt obligated to be paid. If they decided to continue, they need to consider to strengthen their corporate governance by improving their internal control mechanism. They need to fully understand the accounting policy and Companies Act 2016 to ensure efficiency. They will be more prepared in dealing with this type of case. If they make up to wind up the company, all the assets they own will be sold to pay what they owe. Based on the solvency ratio analysis made, MIM should make up their mind to wind up their company since the high ratios indicate the inability of MIM to continue their going concern. Going concern is an accounting term for a company that has the resources needed to continue operating indefinitely until it provides evidence to the contrary. This term also refers to a company's ability to make sure there are enough money to stay afloat or to avoid bankruptcy. Given to the situation faced by MIM, they should consider to wind up the company. That's all from me. Thank you.